Good morning, Barry. How are you doing?
Good morning. How are you?
Fantastic. I'm glad that we're spreading the word about Masters in Business right now because here we go again. I mean, my financial guy said we're in a bear market and we need to pay attention.
Yeah, I mean, you always have to pay attention as to what's going on in the state of the market. The challenging question is, what do you do about it?
Right.
And most people tend to do, or I should say, many people tend to do the opposite of what they should, which is take a deep breath, understand that bear markets are temporary, and unless you need your money pretty soon, 2, 3, 4, 5 years, if you're an investor looking out 5, 10, 20 years, if anything, it's a tends to be an opportunity to upweight your allocation towards equities because, hey, things are on sale.
The importance of transparency, and especially when it comes to the analytics of your money and stuff like that. I mean, because I get those letters in the mail, I get the hookups and stuff like that. But does the average person know what they're looking at?
Yes and no. I mean, the monthly statements or quarterly statements tend to be filled with like pages and pages
Yep.
of, small print, boilerplate. Look, here's what you want to know. What is your financial plan? What are your goals? Are you on target for those goals over longer periods of time? And if you're not, what do you have to do to get to where you want to be? Sometimes it's a matter of upping your contributions to your 401k or your retirement plan. Sometimes it's a matter of being, every now and then we'll review a portfolio and we'll see you're 30 years old. Why are you 40% bonds? You're way too conservative for your age group. And every now and then we'll see the opposite. We'll see somebody who's, 68 years old and they're 100% equities. And hey, that's a little aggressive. Are you comfortable not having a little ballast to offset that when the market sells off? Although this year has been unusual because we have both stocks and bonds down double digits, although bonds fell obviously much less than stocks did.
Haven't they turned a lot of people into basically gambling? Because, I mean, look at what happened to GameStop. All of a sudden you had a lot of people make money, and boy, did they ever lose some money too.
Yeah, I have Spencer Jacob coming up on the podcast in a couple of weeks, and he literally wrote the book on GameStop, meme stocks, and all the craziness, AMC, Hertz, all the wacky stocks that just blew up. There's a pretty strong case to be made that around the same time as the lockdowns began and sports and gambling were cut off, people got stimulus checks and they found themselves home bored with nothing to do. And at the same time, apps like Robinhood, which really gamified trading, became ubiquitous. Robinhood's been around for almost a decade, but people really only discovered it during the lockdown when, hey, there's no sports, there's no casinos, there's no vacation travel. We're bored and we have cash in our account. What are we going to do? Well, might as well, take the stimmies and our diamond hands and to the moon. That was the philosophy. A lot of us people who have been around a few market cycles and have seen this before said, well, we know how this is going to end. We just can't give you an exact date. And ironically, here we are. The first half of 2022 is almost over. And exactly what the old fogies warned the young studs about pretty much happened. My favorite moment from 2021 was this, a very good looking couple on TikTok are explaining how they support their lifestyle. And their answer is they day trade, but their secret is they only buy stocks that go up. And if they don't go up, they don't buy them. I'm like, didn't Will Rogers say that like a century ago? But he was joking. You TikTokers are serious about this. And that's really been fascinating. In fact, there's been a whole subgenre of financial advice on TikTok that ranged from awful to, I want to say, criminal, prosecutable, just like the worst sort of dumb. There's an old expression. It's very difficult to tell the difference between a genius and a bull market. And once the bull market stops, suddenly you discover, oh, you people aren't geniuses. You're just playing the right side of a rampant bull market. Now that it's over, we find out you don't have the slightest idea what you're doing. Thanks for the 60-second TikTok video.
Man, I'll tell you what, that came under attack yesterday from Elon Musk, and he says that's a dangerous tool, and it's like, oh my God, here we go again with this app.
It's funny because I want to see what's going on with Robinhood, and I opened the app. I began my career in the 90s as a trader, so I've used just about every type of trading application and website, and you name it, from a NASDAQ level 2 and 3 to Fidelity and E-Trade and Schwab and those. And the fascinating thing about Robinhood is it's a fun sort of interactive game, but it's not an especially good app as traders. But you could see how, hey, if you're 20 something and you live on your phone and everything you do is right there on the phone that you're playing with, how this is just a natural step over. And so, the Redditors and the Wall Street Bets and that crowd, they really were able to move at least a handful of stocks by operating together. Kind of reminded me of the Yahoo message boards, only from the 1990s.
Yeah.
Only much more coordinated. The difference between now and then was social media and the ability to operate as a swarm as opposed to groups of individuals. Really, really interesting how it worked. Not surprising that for many people it ended in tears, but a handful of the people who were in early and held at least for a couple of months did very well. And that sort of FOMO, that sort of fear of missing out, drove a ton of people into the space. As always, late to the party. The old joke on the trading desk was last man in pays for beer. only the late buyers are the ones who are stuck holding the bag when the early buyers start to sell. Trading is a zero-sum game, meaning for every winner, there's a loser. And it's, we can't all be rich from trading. Someone has to be on the other side of the trade. Yep. And we learned that all too well this past year.
Yeah, boy, that just reminds me of so much, because I get the opportunity to talk with a lot of people that are playing the Powerball and Cash 5 and all that kind of stuff. And I ask them, I say, you won this money? I didn't win anything. All I'm trying to do is catch up on the money I've spent. And I sit there and I wonder if stocks are the same way. Is that we're not, are we making money?
So it depends. Are you an investor or are you a gambler? Are you a speculator?
Right.
I love the fact that the Redditors call themselves degenerates. That's their own name. But many a truth is spoken in jest. We know what the returns of asset classes are going to be over long periods of time, over decades. Real estate is going to give you this above inflation, and equities are going to give you that, and bonds are going to give you this on average over long periods of time. But it's not a straight line. There are moves forwards, there are setbacks. Nothing goes straight up or straight down. It's always 2 steps forward, 1 step back. And so if you are an investor and have the ability to put your money away, tie it up for a decade or longer, you're going to probably do pretty well. If you're throwing darts and buying stocks, and the question I always ask people who are active on Robinhood is, what is your edge over the other 20 million people who are buying and selling stocks every day, including the big institutions that have enormous capital, huge computing power, very skilled, very savvy professional traders? What's your edge against them? And if they can't answer that question, you know how it's going to end up. It's going to end up badly. They're just like every gambler thinks that this is the game that puts them back into the green from the red.
Yep.
You end up with that same sort of personality, which is, hey, I just need one big hit. And lo and behold, to me, the value of a lottery ticket for $2 on $100 million Powerball, it's worth $2 to stop and think about, what would I do with all that money? That's what you're getting for $2 is 15 minutes of fantasy.
Yeah.
But you really aren't getting that when you're buying and selling, crappy companies that have no real long-term perspective. Maybe there's a rally in them. GameStop is a great example. That was a crowded short position. Too many companies and trading firms had bet that they were going out of business. When it turns out, hey, if they migrate to the web, then they could be like an Amazon or a Chewy or so, or even look at Target and Walmart, how they added web businesses to their regular businesses. So it was a crowded trade, and they managed to orchestrate a short squeeze, and it went to the moon. But that's one company. How often can you actually do that?
Yeah. Here in 2022, I'm glad that I made the investments in the 1980s, because you're right. You've got to be able to have that long-term vision. I'll never forget my guy telling me, "Go over there and sit down. Let me do my job, because you'll never see me in a radio station studio. So therefore, let me do my job, and I promise you, your future will be brighter."
My favorite expression is, "Don't just do something, sit there." Which one of the things that we've learned over the years is the single biggest determinant of people's investing success is their own behavior. And that's the shocking thing, is that if we can manage our limbic systems, if we can avoid that fight or flight response, if we cannot make emotional decisions but be calm and collected and logical, we tend to do better. But it's easier said than done. To me, it doesn't matter which index fund you own or which mutual fund you own, or even if you want to be a stock picker. All those things are secondary to your own behavior. You can't control what the market's going to do. You can't control what the president or the Congress or the Federal Reserve is going to do, but you can control how you react to it. And we've noticed that people who get all enthusiastic and greedy and buy a lot of stock at the top and panic and can't sleep at night and dump stock after it's sold, they tend to do poorly in the market. And it's not because of what they own or what the Federal Reserve did. It's their own behavior. It's the single biggest determiner of the average person's success in the market. If you can get that under control, you're ahead of 95% of the rest of the investing world.
I love the people that you invite to Masters in Business, and one of them being Arnold Schwarzenegger, because until I heard him on the show, I mean, it was like, I didn't know he was such a businessman. He is all about business.
So, yeah, he's put together a tremendous portfolio of real estate and businesses, and he's a very, very savvy guy. The fact that he's an Austrian bodybuilder led a lot of people to underestimate him. And once you ended up with him as governor, hey, if he wasn't a non-U.S. born individual, he very easily could have become president. Yep. I have no doubt in my mind. And it's not that he's just an actor. He's an incredibly successful businessman off the screen. That's not his sole source of income. He's a really impressive guy.
For listeners that don't know what the emerging markets are, I love the way that Mark, who is the godfather of this, he says it's very possible that things change. But is it possible today for emerging markets?
So Mark Mobius started doing emerging market investing in like the 1980s. It's 40 years ago. And, historically, when you have these regions of the world that are growing very fast, their stock markets have done pretty well. When he started, there were literally only 6 countries that you can invest in, because you couldn't get money in and out of the country. Literally, you could not. They didn't have the banking system. They weren't hooked up to the rest of the global SWIFT system and the ability to just move money around. Today, that's changed. And a lot of these emerging market economies aren't as dependent on commodities as they used to be. So you look at countries like Vietnam or Turkey, they're become manufacturing powerhouses, and they are operating as an alternative to putting your money in China as an investment. And so he talked about, we've been waiting for the rise of Africa as an investable
Yeah.
area for a while. That's starting to come online, and you're starting to see signs of possibility in South America. You look at places like Venezuela and Brazil, even with the political challenges that we've seen, and go down the list of countries, Nicaragua, Colombia, Panama. It's a difficult region, but that's what makes it, that's what gives you the potential upside is people look at it and say, I don't want anything to do with it. Hey, I have no money in Russia right now, but at a certain point in the future,
Mm-hmm.
once Putin leaves, people are going to start looking at Russia and saying, "Oh, maybe this has become so cheap that we have to get into it." As long as they are an illegal occupier of Ukraine, as long as they're committing war atrocities, I don't think they're investable. But Mobius points out, we've seen this time and again. Look, we're big investors in Japan and Germany. Go back to World War II. That was unimaginable then. But once the war ended, people's perspective changes. So it's way too early to put money into Russia. But at a certain point in the future, people are going to may look at Russia, and I'm no expert in emerging markets, Mobius is, but what he was suggesting is people will be looking at Russia off in the future the way they eventually looked at Germany and Japan after World War II.
I'm no expert with what you guys do and stuff like that, but the thing that I do have as a regular person with fear is I fear the price of housing right now is there's not going to be any first home buyers out there. And number two, these people that took an early retirement, that's still money that could be invested in the stock market. But if they're not making the money to do it, how does that change the world?
So let me unpack that because there's a bunch of questions in that. First, so when we look at housing, following the 08-09 crisis, and let me point out, housing topped 2 years before that and started to roll over, which is what ultimately the defaults and mortgages, one of the factors that helped drive the 08-09 crisis. Home builders sort of threw their hands up and walked away. They stopped making as many single family homes and started building multifamily apartments. And so a decade later, almost 15 years later, we have a shortage of single family homes. The population kept growing. Mm-hmm. The number of single family homes didn't. And at the same time, you had a lot of people coming out of the crisis. People graduated college, they stayed at home. It was almost a cliche. They were living in their parents' basement. So we're way behind where we would normally be, thanks to the financial crisis, in terms of the economic term is household formation, meaning when a couple gets together, moves in together, and they start either decorating or buying and decorating an apartment or a house. So we're way behind in that. And then by 14, 15, 16, things started to tick up. And then came the pandemic, and we had all this money flow out into trillions of dollars flow out into people's pockets. Suddenly there was a huge demand for housing. Mm-hmm. So it'll take a couple of years for that to catch up. I've never been a big fan of the generational investing theses. They just, it's so challenging to tell the difference. If you're 30, 40, 50 years old and your parents leave you a chunk of money in the form of stock, most people have a tendency to draw from that when they need it. Mm-hmm. It's not like, there's a $20 trillion generational wealth transfer and everybody's going to sell. It tends not to happen that way, especially if you're 40 years old. Hey, I don't need this money for retirement for 25 years. Maybe I'll take a little bit of it out and either upgrade my house or move to a nicer neighborhood. But that's very different than, I'm going to take the $2 million that, and I'm trying to remember what the average size of the generational wealth transfer is, but it's a substantial chunk of money. People have a tendency not to liquidate it and spend it like a lottery ticket. They tend to be, wow, for the first time in my life, I have a big pile of cash in the form of this portfolio. I'm going to readjust it and take out only what I need, but this is my retirement and my kids' colleges as opposed to just fun money. At least that's what we've seen historically. So I'm less of a demographic wonk and more of a that's not how people behave in real life sort of a way. And P.S. We heard the same thing, 2 decades ago. Oh, this is it. The boomers are rolling over, and they're already retiring 50,000 a day, and that's gonna kill the stock market. And it hasn't. The millennial generation is now bigger in numbers than the boomer generation,
Wow.
which is kind of surprising. Listen, the in between was an echo. The boomers had kids, and now these are the boomers' grandkids. And they're buying houses and they're working and they're creating apps and they're going to own equities, hopefully holding them longer than they did with Robinhood, um, during the pandemic lockdown.
Wow. Barry, you got to come back to this show anytime in the future. The door is always going to be open for you.
My pleasure. Anytime.
Excellent. Well, you be brilliant today, okay, sir?
Thank you so much.